All right, Bruce, time to put the misconceptions away. Okay.
So
what are the economic things, the triggers that make mortgage rates fluctuate up and down?
Okay, well, there's several things that can cause mortgage rates to fluctuate. First of all, you have to understand that mortgage rates are not tied to the federal rate. They're not tied to the Fed rate. Okay.
Thank you for that.
So a lot of people think they are. I always get phone calls. Oh, the Fed just dropped the Fed rate a half a point. That must mean interest rates are a half a point lower today. Negative. Matter of fact, oftentimes, as we've seen lately, they went up rather than go down.
Correct.
The reason for that is mortgages are tied to the 10 and the 30-year treasury bonds. Okay.
Yep.
So treasury bonds are what dictate what interest rates are and what the yield is on the treasury bond. So we want treasury bonds to be high.
Yes.
That brings interest rates down.
Mm-hmm.
So what affects the treasury bond is the real question. So economic monetary policy changes can always affect the treasury bond, but primarily you have inflation. So inflation is the arch enemy of the treasury bond.
Mm-hmm.
If inflation is high, you're going to see interest rates go up.
Yep.
Okay. Now, then you have things like you've got the Fed dropping the Fed rate. How did that raise interest rates? What would cause that to happen? So you have to understand the dynamic or the relationship between the Fed rate and the bond rate and equities, meaning stocks.
Yes.
So why does the Fed drop a Fed rate? Why would they ever do that? For what reason? Do you know what it is?
To increase people's interest in buying goods.
Right. To stimulate the economy.
Right.
So that's the only reason. Or to raise interest rates would be to slow down
Correct.
the economy, right? It's going too fast.
Right.
So that's how they adjust it. And that's one of their only means other than printing money to adjust interest rates. So when the Fed dropped the Fed rate, what do you think it did to the stock market?
Oh, it went through the roof.
It did. It rallied, right? Which is typical because people feel like there's more money, right? There's cheaper money. So they're investing in the stocks. Well, when stocks are doing well, it sucks the energy out of the bond market.
It sure does.
And so when it sucks the energy out of the bond market, interest rates go up. You have to remember, institutional money wants to make money on their investments, meaning hedge funds, insurance companies, anybody that has any of these big companies that are moving billions of dollars around. So when there's opportunity in the stock market, they move to the stock market because that's where the money's to be made.
Yep.
But when there's uncertainty in the stock market, they park their money in the bond market.
Which is where you can always get a good return. You're always going to get it.
You'll get an okay return. You're not going to make a fortune, but you don't lose money typically.
Yep.
It's a great place to just park and wait and see.
Yep.
And so right now, nobody wants to park and wait and see. They want to be in the stock market.
They want their gains now.
The gains are being made right now.
Right.
So those are the things that are affecting interest rates. But I'm going to tell you something. Even though interest rates are a little higher, I do expect that as time goes on, we're going to start to see some improvement in the market. Does that answer your question about interest rates and how they change?
Perfect.
Great.